I'll take it you already saw the title for this video as well as the thumbnail, so you know that we're going to be talking about Blackstone. But we're not talking about the Blackstone that makes those backyard griddles, which are amazing by the way. We're talking about a different Blackstone. So let's go ahead and play the intro. Hey everyone, and thanks for joining me today. My name's Matt, and before we get started here, I just need to say, not advice, don't take it as advice. If you need advice, speak to a financial advisor, but this is just for your entertainment purposes only. Also, I'm going to apologize in advance here if this video is a little bit short or if I sound a little bit rough. My allergies are pretty brutal today, but I really wanted to make sure that I got this video out today because, well, today is actually a very special day. It's the 1-year anniversary of me starting this Watchlist Wednesday series, which is very exciting. I can't believe it's been a year already since I started this. And I just want to say thank you to all of you who have been here with me throughout this journey. I really did start this series with hopes of giving people a different perspective of ways to invest. There's a lot of great YouTube channels out there, but a lot of them tend to have a very similar approach towards their presentation, whether it just be showing graphs or showing different articles and whatnot. And I wanted to show you how I think about these investments a little bit outside of the box. Also, with this now being a year of me making these videos, I would really love some feedback for what I can do to make these videos a little bit better, more entertaining, maybe have a little bit further of a reach, because admittedly I thought that this would have done a little bit better for my channel than it has. I'm still very appreciative for everybody who subscribed, liked, followed along throughout all my tangents and journeys with these stocks, but I just would love some feedback from all of you who do watch my videos to see what can I do to make these videos either better or more enjoyable, or make it so that you're comfortable sharing it with friends and family so that they can also learn to become a better investor. So please leave some feedback below for what I can do to improve my channel and give you better quality content. Anyway, back to Blackstone. So if you're not familiar with the Blackstone Group, they're very similar to BlackRock. Not the same company anymore. They were the same company many years ago, but they've since separated. But ultimately what they do is they take money from pension plans or accredited investors and invest that to create private funds. Some of the fields that they invest in would be things like mortgages or real estate investments. They also have credit opportunities and investments in private equity. So it's something that you might have an investment in your 401k or employer plan through, but if you're just a regular retail investor, you might not have any investments from Blackstone. I currently don't have any investments from Blackstone. I don't work for an employer or anything, so I don't really have the opportunity to add these to my portfolio. So I figured might as well take the next best step and invest in the company itself. Now, this kind of company is very complex, and it's a lot different than just trying to do an analysis of a company like Apple. So I'm still going to do my best here to give you some info about this. And the company that we'll be comparing Blackstone to for the numbers is Brookfield Asset Management, who is a very similar competitor or in the same field as Blackstone. Again, you might have not heard of either of these companies before, but I think they both provide a great value to the investor. So looking at these numbers here, we could see that when you look at a forward PE ratio, that Blackstone looks a little bit more favorable than Brookfield. That being said, currently Blackstone does have a PE ratio of over 50, so right now Blackstone might be at a little bit of a premium, but it does look like it'll get cheaper as we look forward with this as an investment. The reason why I did forward for this as well is because Brookfield doesn't actually have a 12 trailing months PE ratio currently, or none that I saw at least. So I wanted to do the forward so we can at least have some numbers to compare here. And it does look like based on these numbers that Brookfield could be trading at a premium in the next few years. As we also see though, when it comes to the price to sales measurement, this is where the tables turned a little bit. We see Blackstone actually looking very overvalued compared to Brookfield, who's at 1.10 for their price to sales ratio, which is actually a really good price to sales ratio to see. We're going to flip the tables again though, because when it comes to the forward-looking revenue growth, this is where Blackstone shines. 5.90% isn't necessarily the most exciting number. Yes, it's better than the negative 15.29% that we'll see for Brookfield, but the 5.9% isn't really anything to get that excited over. Now, again, this is a different kind of company that we're looking at, so we don't expect them to grow like a Tesla, Square, or PayPal. But it is something that I always like to see being a little bit higher than just 5% forward-looking. If you're a dividend investor too, you might tend to favor Blackstone over Brookfield, given these dividend yields and dividend payout ratios. 2.88% compared to Brookfield's 1.08%. It's a pretty significant difference, especially if you are going to own more than just one share of these companies. So if you are a dividend investor, that'd be something worth paying attention to. As we can see, this kind of correlates over as well to the payout ratio. We have Blackstone at 69.44% compared to Brookfield's 20.98%. I do want to say here that with these companies being investment companies, so they make investments, when they have a higher dividend payout, that doesn't necessarily look the greatest to me, because these companies are going to have to free up a lot of capital to continue their investments into new companies or expanding into other businesses. When you decide to invest all of that back to the shareholder through a dividend payout, that means that you're not going to have as much capital to use to make other investments. And with me being very much a growth investor, I do prefer to see companies take money and invest it back into the business to help their growth, as opposed to paying it out in a dividend. But I also understand that this company still has positive looking forward growth, so they can probably justify having the higher payout ratio than its competitors. And lastly here for the current ratio, kind of the same, 1.47 compared to 1.40. Again, this is going to be a crucial number to take into consideration because these companies do need to have capital readily available for them to make investments or to quickly act on investment opportunities that might come around for them. So now I'd like to spend just a little bit more time kind of clarifying how does this company actually make money, because they have a few different operations that they run, but they're not limited to just the ones I'm going to list here. The first one is through real estate. So they do a lot of real estate investing, and they actually tend to have a more buy and hold strategy. So their objective for making money through real estate with this buy and hold strategy is by buying residential properties that they'll rent out. That rent creates a source of income for them. They'll also be able to experience capital appreciation by holding on to these properties for the long run, as well as being able to take advantages of the tax write-offs for owning the properties themselves. So the real estate aspect actually tends to be a large portion of their business, and they are one of the largest holders of real estate, if not the largest holder of real estate. And one of the companies that they make these purchases and acquisitions through is Invitation Homes. They also make money through the credit markets, so this is usually where they loan money out to businesses, and basically with that, pretty obvious, they'll just make their money back through the interest payments. Now they do have some high yield quality bonds that they'll invest through. They have distressed businesses, distressed energy companies that they'll loan money to. So it is a little bit risky of an investment. I'm not a huge credit investor myself or a huge fan of credit, but one of my favorite investors, Howard Marks, is a huge credit investor, and if it works for him and his company at Oaktree, then I don't see why it wouldn't work for Blackstone as well. Again, just an area that I don't have as much experience in or knowledge of, so it's not something that I tend to look at. They also make money through their funds. This could be through an advisory and a management fee. So if they take all these investments, bundle it together, and then sell it back to either advisors or pension plans, then they'll essentially make money the same way mutual funds do through expense ratios. And that makes sense because they're the ones going out seeking these investments, managing them, finding the right companies to put the money into. So that's how they'll make their money through those investments as well. And then the last one here that I wanted to touch on is private equity. So they do a lot of investments in companies that are private currently, and either they're going to help them become public, whether that be through a SPAC, or they'll hold on to them and let them just be a spin-off company through their branch. But they do a lot of private equity investments. Some companies that you might have heard of that they either have held on to in the past and have sold off of, or still have a large investment in, would be companies like Ancestry, Bumble, and Hilton. Now, as I've kind of said before, when it comes to companies like Blackstone, they're the experts here, and I tend to utilize experts' knowledge and information when it comes to my investments. So if they are the experts in these certain industries and do very well with the way they allocate their assets towards those industries, then I'm not going to try to beat them or outpace them because they're a lot smarter with the money than I am. So that's why I like buying into companies like these, because I like their investment strategy, I like their investment philosophy, I like for the most part the sectors that they target, and the one that I'm not a huge fan of is one I just simply don't know about, and that's again the credit markets. So if they are incredibly knowledgeable and have a great reputation in the credit markets, then I'll trust their expertise and just put my money into that company so that way they can get the returns for me. I hope that makes sense. Now, there's a lot of different investment management companies out here that you can invest in. Even Brookfield, the one we were doing the comparison to earlier, has investments in like oil. So if that's something you're interested in, then maybe you'd consider that. When you're looking at these investment companies, though, it's just important to look at the type of investments that they have. With me being a real estate person, I'm obviously going to be a little bit more attracted towards a company like Blackstone because I understand the real estate investments. I'm a huge fan of real estate investments and their benefits that they provide. So I like their investment objective. But if you're not a real estate person, maybe you're more of a tech person or maybe a farm investment kind of person, I don't really know, then look for other investment companies out there that are more in line with your objectives or investment philosophies. But ultimately, that's the reason why I chose Blackstone. So I am going to go ahead and add this one to the portfolio. Let me go ahead and do that real quick, and I'll be right back with you. All right, so you might see here I did a little bit of changing around to the portfolio, so that way you could see more of the information for these positions I buy. I want to make sure all of you were able to see like the average price that I paid, the last price it was trading at, just for sake of full transparency, so you know what I purchased these positions at, in case you're watching this video down the road. Anyway, enough about that. So as you can see here, we bought 75 shares of Blackstone for around $78.49 a share. Last price was only $79.39. Gave us a gain of about $67, but obviously that's just a very small movement that can swing pretty easily when you own 75 shares. But also gave us a market value of just shy of $6,000. So again, more than what I would typically invest in at once in a company. But I like this company. I like the way that they're diversified. If you listen to their earnings calls and how they plan for the future, it's very promising for an investment company. So overall, I'm very excited about this company. Admittedly, it is a company that I've been wanting to do for a while, but I just figured it wouldn't do that great because it doesn't rank that high on like the YouTube search rankings. But I'm starting to move kind of beyond the whole just making videos based on how well it'll do for my channel and focusing more on the companies that I actually want to talk about so that all of you can learn about these companies as well. Anyway, enough about that. Just taking a look here at some of the other investments. Tesla's doing fantastic for us. That one's up almost $1,000, which is great. VOO doing pretty well for us, up $171. Again, that's not one I expect to be a huge gainer, but one that I think will more balance out or stabilize the portfolio. Jumia is doing very well for us, up $455, so I'm very excited about that investment in here. And then to finish it off, we do have Square at $353. So it's a very pleasant surprise to see that everything in here is green. Admittedly, I wasn't expecting that. I know the market's been doing well, but it's not every day we see every single position up, so I'm very encouraged by that. That's my review of Blackstone here. Again, I'll apologize in advance because this video was a little bit shorter. I didn't really get to go into the detail I wanted to, but my allergies are absolutely killing me. So if you are interested in this company and want me to explain it in more detail, leave a comment below and I'll definitely make a follow-up to this video. If you like this video, remember that's a 5-cent donation for charity, so go ahead and like it if you haven't. Also, if you haven't subscribed already, that is still a 10-cent donation to charity. But most importantly, please leave me feedback below for what I can do to make these videos, again, either more entertaining, enjoyable, better quality, anything along those lines, because I want to make sure that you're enjoying watching these videos and not just getting the information from them and kind of suffering through them. So let me know your feedback for what I can do to improve these. Anyway, I'm done here, so thank you so much for taking the time out of your day to watch this. You could be anywhere in the world, but you're right here with me, and I really appreciate that. But I'll let you go ahead, enjoy the rest of your day, and I'll see you next time.